Sometimes in life you have no choice but to go all in. That doesn't mean it's automatically a nail biter. Here's why I'm all in Bitcoin and why it's not necessarily high risk. As the title proclaims, I am all in, but not just in Bitcoin, I'm all in Bitcoin and Ethereum. The reason for this is part of my 2021 strategy, but before we can discuss the strategy itself, which will be presented in full in the next Bitcoin series episode, we need to give context to the elephant in the room, the all-in move. Now, there are several reasons behind this radical move, but it's not as irresponsible as it may first come across. First of all, and to give you some background, there's an elemental reason to why I do this, the all-in thing. For as little as I may want it, it's a necessity. We discussed this forced upon move in detail in this episode, so please watch it for the full story and to understand the soft gaming theory reasoning behind it. But to quickly summarize it, when I busied myself at learning technical trading, I traded indices at leverage. My mistake was that I took on way too big positions and at way too high leverage. This eventually caused me to blow up and I'm still recovering. Much of it has been regained, but I also live off my portfolio, and as London is not exactly a cheap place to live, something needs to happen to get my portfolio back into its safe zone. One in which my annual living expenses don't breathe too much down my neck. I'm almost there, all I need is a little nudge, but it's still needed or else my expenses will eventually not just kill my portfolio growth, but my entire portfolio too. And no, we can't just move. My wife lives here too and has a life and career of her own. I put myself in this spot and it's my responsibility to resolve it. All in all, a portfolio status quo, as in nothing happening, is more risky to me than taking risks. And therefore I need to play aggressively whenever rare situations arise, like now. But first and as always, not financial advice. I do not advocate anyone to put all of their eggs into one basket. With that said, you may find this content to be highly relevant as it gives a good outline on risk, what it is and what it isn't. For everything you do on the market involves risk. And the better you understand risk, the better your chances of maximizing your returns. And that's exactly what we'll discuss today. To begin with, there's risk and there is risk. For not all risk is the same. Far from it. When you look at a chart, each and every spot represents a different outlook in odds. Whether you know it or not, some spots offer majestic return potentials and little downside, while other spots are shared danger zones. This is why we apply technical analysis to better be able to identify high return, low risk opportunities and to isolate and stay clear of high risk, low return traps. People erroneously believe that all high risks automatically come at high reward opportunities. That is absolutely not the case, and the sooner you can learn that, the better. Most high-risk investments come at horrible return prospects. We're talking rolling a die and only getting paid 2 to 1 whenever your number shows up. Any high-risk bleed-to-death stock will tell you the same story. Now, a key characteristic to identifying high-return, low-risk spots is that they are just that, low risk. It absolutely doesn't mean they come without risk. It just means they are much less likely to be exposed to unpleasant downsides. And on top of that, the statistical downside will be significantly less than that of a danger zone. A long accumulation phase, or simply an exaggeratedly extended sideways range in a fundamentally strong company, is the ideal high return, low risk spot to enter a position. But that, on the other hand, requires that you can accurately distinguish it technically. This can better be likened to a city map of a city you have neither been to nor know anything about. As with any city, some areas will be safer and some will be less so. The city map is the graph itself. Technical analysis is to have the respective areas marked out so that you can decrease your risks of getting mugged or ending up with a knife inside of you. This of course doesn't mean you're immune to crimes just because you so happen to hang around outside the police station in the safest neighborhood. Crimes can still occur, but statistically they will happen far less often and with far meeker consequences than if you were to show up in Gangstaville at midnight in your Dolce & Gabbana fur coat and brand new Rolex. Hence, with TA and a good psychological and behavioral understanding of certain markets or equities, we can distinguish good risk from bad risk on any given chart. This of course presumes that you know what you're doing, for if you're bad at reading and interpreting that map, you may still end up in Gangstaville. Let's now assume you have identified a low-risk entry spot and moved all in. What then are you looking at from a risk point of view? If you're all in a single stock, or in Bitcoin too for that matter, as long as you haven't utilized leverage, the statistically worst thing that can happen is that you lose some of your all-in position. For a company doesn't just go bankrupt overnight. And even if they were to, unless it's been demolished by inside fraud, there are typically plenty of fundamental and technical clues along the way which should have prevented you from even looking their way. Sure, flash crashes and black swan events do occur, but they can happen on a larger scale too and screw you over even when you're diversified. I know several people who had their private fortunes decimated in the February-March stock crash last year. But putting these outliers aside, you can typically get out of the way at a maximum of 10 to 20% damage whenever you're wrong about a high return low risk spot. A damage that altogether invalidates the bull case scenario as well. For if your trade goes against you, if it doesn't pan out in the bullish fashion you had first anticipated, you typically have plenty of time to get out. In those cases, unless an outlier were to mess with you, you have no excuse to lose any more than those 10 to 20%. And that still leaves you with 80 to 90% of whatever you started out with. And this is exactly what I've done. I have identified a technical high return low risk spot in Bitcoin and Ethereum in which I stand to profit handsomely at a modest risk. Simply put, I'm in the safe part of the city. But there's more. In contrast to being all in, a common fallacy is the belief that diversification is the key necessity for investing success. Sure, overall diversification is a good and well-tested way to keep your risks low. At least if done with moderation, for you sure can over-diversify your portfolio too. But despite its many proponents, it's not as straightforward as some make it out to be. The main problem with diversification is that there are many misconceptions about it. Owning 10 different tech stocks, for example, isn't diversification at all, for if one falls, the others typically follow. At least short term, as the different market sectors tend to move somewhat in shoals, like millions of little fish that all turn at the same time. Neither is it diversification to own 20 or even 30 different stocks in different sectors, for once the market tanks, they'll go down in unison. Diversification means to own equities and assets that are non-correlated or negatively correlated with one another over extensive periods of time. Proper diversification can be seen as a scale where the higher diversification brings the risk down in relation to that of the markets, but at the same time at the expense of lower returns from the mean. This is a grossly oversimplified way of viewing the very concept of diversification. In reality, a highly diversified portfolio simply means it will increasingly mimic the moves of certain indices or those of the market as a whole. It doesn't make you immune neither to the risks nor the downsides, for as recently mentioned, flash crashes and outlier events can still hurt you badly. However, the same principle doesn't necessarily apply in reverse. Fewer simultaneous investment positions don't automatically equate to higher risk. I'm gonna try to keep this simple, for the full explanation is rather mathematically complex. The entire point of this is to show that my Bitcoin all-in isn't necessarily as risky as it may sound, at least not when you put the entire picture together. This is where the technical analysis come into play and the ability to identify high return, low risk spots. Let's look at a simple example. Which of the two is less risky in the short to mid term? A. Going all in Bitcoin, or 2. Buying 20 stocks from different sectors from the S&P 500, which is still not a proper diversification, by the way. Naturally, being equipped with no other information than this, the 20 S&P stocks pose a lot lower risk as Bitcoin is known to be stupendously volatile. Most people would go with option B, and rightfully so. But let's then add a key ingredient to the mix, namely knowledge. Now, which of the two is the less risky short to mid-term prospect this time around? Buying the Bitcoin outbreak after a 3-year-long power amassing accumulation phase, or buying those 20 S&P stocks at their very distribution phase without your knowing? In one case, the technicals reveal a buyer-seller ratio that strongly favors the buyers, one which, if it were to fail, you can simply sell it back again at a minor loss. In the S&P case, however, the buyer amasses a bulk of stocks whose upsides are already satiated. Now, if you had to choose, would you rather go all in at the technically and statistically right time in Bitcoin, or would you rather stay diversified for the same amount in your S&P stocks, unknowingly that you are soon to be facing a long-lasting markdown? Shockingly, some people would still choose the latter. This can come down to several reasons, of which being in it for the long run is one of them. And that's fair, but in most cases it doesn't come down to longevity. It rather comes down to the lack of understanding the market and its technical, statistical, and psychological behaviors. But if you so happen to have eaten from the tree of trading and market knowledge, and you know that one of the options has a strong chance of returning strong profits, and the other option has a strong chance of losing you some decent money for quite some time to come, would you still choose the latter? Probably not. In this sense, what many fail to understand is that putting all of your eggs in one basket isn't necessarily that risky. That is, as long as you know when to do it and where to do it. And this all comes down to one thing: knowledge. To be perfectly clear, this entire project in which you invest heavily into something assumes you know what you are doing, that you know your market, your equity, and your odds scouting abilities, that you have knowledge. When moving in this aggressively, technicals alone won't suffice. You need to really understand the underlying product or concept, at least if you expect to be strong enough to stay on course with your conviction. Sure, you can still go in heavily on something without fully understanding its underlying structure and value, but then it's gambling and nothing else. During my years as a non-technical position trader, I had been all in twice and twice only. Once in fingerprint cards and once in Bitcoin, both lasting for about 2 and 2.5 years each. When it comes to fingerprint, I spent an estimated total of 1,500 hours at researching the company between 2012 and 2015. Similar research was then dedicated to Bitcoin and blockchain technology. So what happened? Well, despite having done my research, I didn't yet understand the market and its nerve-wracking price behaviors. Hence, every turbulent move, and believe me, they both had plenty of those in store, scared me senseless, and I caught myself buying and selling at the worst times due to emotional impact. And in the end, I ended up selling off my positions way too early. And so, due to my lack of technical and market cyclical knowledge, I missed out on most of the fun. Twice, as both shot through the roof with stupid percentual run-ups. Today I know the markets, my technical abilities, and I know Bitcoin. I may be aggressive when taking big swing positions, but I never move all in unless I have done a proper fundamental due diligence and all the stars align. I've done that before and it just doesn't work. Knowledge is power, and this is why market studies, whether the psychology or technical behavior thereof, is central to your achieving an edge. For as mentioned, when we look at a graph, each and every spot comes at different odds. Some are easier to identify than others, which is also why we as technicians try our best to be patient and to adapt our position sizes in relation to our estimated advantage. The stronger the spot, the bigger position we can justify. Tesla and fingerprint cars' long accumulation phases backed up by brewing fundamentals are prime examples of this. For counter to what any skeptics may say, these spots right here were in fact low-risk entry spots. And anyone who has watched the entire Bitcoin series has come far already at learning about Bitcoin's technical behavior. You know very well by now that the only time Bitcoin goes bananas is throughout its markup phases, but that it also needs to properly rest and recharge during its accumulations. When you know what to look for and when you know enough about the underlying fundamentals, as in Bitcoin's potentials and what actually goes on behind the scenes, you can further nuance the risk levels on the charts. In that sense, this breakout from the previous all-time high does signify a low-risk, high-reward opportunity. Being all in Bitcoin and Ethereum today, I understand their very market behaviors. I know their technicals inside and out, I know their cyclical movements, and I am no longer afraid of entering the battlefield. I now have a good map. I just hope I won't get mugged and stabbed outside the police station. But why Bitcoin? Why not gold, silver, or some strong-looking stock with solid fundamentals? Glad you asked. Here's why. So why then have I put all of my money into Bitcoin and Ethereum? Why didn't I at least spread the risks while still putting all of the money on the line? Perhaps a good chunk of Bitcoin, some real fiction, some Amazon and some fingerprint. There are multiple reasons behind my decision to move in on Bitcoin specifically. First of all, given that I'm on the market to maximize my profits and to give my portfolio that final push to safety so that I can begin working my real magic, I need to be selective and go with the fastest and strongest runner. For as much as I may still believe in real fiction, Cancera, Swipe, fingerprint cards, Neo, Amazon, and most other bullish stocks that I have talked about on numerous occasions on this channel, their upside potentials are just too limited in relation to that of Bitcoin and Ethereum. And we're talking limited both in price development and time and from a technical point of view. For as a trader and investor, we want to exert the highest possible returns at the lowest possible risk. And even if each and every one of the aforementioned stocks were to double in value throughout 2021, they still don't match the markup potentials of Bitcoin and Ethereum as discussed in full throughout this 2021 Bitcoin series episode. This, however, doesn't mean I will not seize any short-term explosive moves in any of these stocks, such as a fingerprint cards accumulation outbreak. It just means my main focus will be just that. Focused. For on top of my Bitcoin and Ethereum move, I also have a year-long strategy which entails internal movements and repositionings between the two, and another blockchain-based entity. What I've done may look simple at first glance, but I can assure you that this single decision could neither have matured nor come into fruition if it weren't for all the necessary knowledge that first needed to be learned. We're talking thousands of hours studying the markets, technical analysis, and Bitcoin as an investment phenomenon. But my strategy is more sophisticated than simply buying and holding Bitcoin and Ethereum until this presumed run-up is over with. In fact, it is highly vivid and will require regular action by which I expect to add on significant value to my positions. But to keep you wondering, we'll save that for the next episode. That was all for now. Thank you and goodbye.